Perfect. Seeing a few more people hop on. Welcome to this week's call. So first thing I wanted to address and just talk through is some big news that came out of the Fed this week. I believe it was yesterday on the 15th or 16th, but the Fed has decided to increase rates, and this isn't anything new to us. This has been signaled from them for a long time. The amount that they increased the rate is notable, and their future plans are notable. So I thought I'd talk about what they did, what they decided on, what they communicated, and then what it means for us as investors, what it means for us primarily as lower no money down investors using methods like the BRRRR model. It also implicates people that are investing in turnkey properties as well. But I want to talk through those things first. So first, what they communicated. You can find this on AP News or any major news outlet. But what they communicated was they are increasing rates. Right now, I believe the rate is at 0%. So this is the lending rate from the Fed to other entities. All right. So they're lending out they're lending out interest-free money right now. They've decided to increase that 25 basis points. So 0.25%. That 0.25% might sound, kind of arbitrary. The reason they're doing this is they want to try and hedge off inflation. And so if they increase the spending or the interest rate on the money that they're loaning, they're hoping to hedge off the 7.9% inflation rate that we're seeing right now. Normally, the Fed likes it to be at or around 2%, but we've seen it at 7.9%, which is the highest it's been in almost 50 years, which is really pretty significant. So it's good that they're trying to address inflation, because inflation over the long term, higher than just moderate inflation, isn't great for an economy at large. And so it's good in one respect, but it also provides some challenges for us. So that's what they decided in the first move that they're doing. Now, how this is going to affect rates, you'll probably see rates bump up a little bit, but a lot of the lenders have already increased their rates to prepare for this, to go ahead and prepare for this coming, right? So if they're going to lock you in at a rate 15 days ago, they knew that this announcement was coming because the Fed has a scheduled date that they meet on. And so that's just something to consider. You might not see rates jump too much because they've already been preparing for this. 0.25% is not that much. It's not a huge increase, what they could do. So that's what they did now. What they signaled for what they're going to do down the road, and it's not a guarantee, but it's a pretty good estimation of what's going to happen. Because barring anything abnormal, or maybe let's say we see inflation decrease substantially back into the 2 or 3% range, then yeah, they're probably not going to increase rates down the road. But what they signaled was they plan to increase rates. So we went from 0 to 0.25%, right? Their lending rate. They expect over the course of about 6 or 7 rate hikes to be at around 2%. So some of those rate hikes could be as large as 0.5%, potentially higher, but I'd be skeptical that they'd go higher than 0.5% in a single hike. So this is pretty substantial as far as lending is concerned. Now, one of the things that we've talked about in the past with relation to lending and deal access is that lending and deal access tend to act inversely proportional to each other, meaning that if money is really easy to find, it's probably going to be harder to find a really good deal because everybody's got access to money, right? Everybody's got access to the money that's available. So I think we will see that. You'll see, and this kind of goes into what we can expect as investors, particularly BRRRR investors or lower no money down investors. Previously, we've said, we want to shoot for a certain amount of cash flow per month and getting all of our money back out. This rate hike won't affect us being able to get our money back out. If you find a good deal that's at 70% or less of the future value of the house, you're going to be able to get your money back out. All right. What it will affect is your ability to cash flow. And not necessarily your ability to cash flow, but the magnitude of which you can cash flow. Because the way that this rate is going to hit us as investors is going to go through the lending institutions. And then the way it hits us is they're going to quote us a higher rate, right? So if we got a 3% rate last month, in the future, and it's a 2% rate hike, we're going to end up at a 5% rate, right? Right now, we're seeing rates higher than that. So it's probably going to be a little bit higher, depending on if you're using conventional loans or commercial loans or DSCR loans, if you will. So that's going to trickle down to us, and a higher rate means we're paying more interest. We're paying more interest, but we're also losing a little bit of cash flow on that, right? So on that property. So what we'll probably see happen is we will be looking at and evaluating deals through a little bit different lens, through a contextualized lens. So our ability to get our money out has nothing to do with this rate, right? But our cash flow might be a little bit lower, right? So that increases the importance of us finding properties that are 70% all in or below of the future value, because our cash on cash return is going to be harder to chew into our initial investment, because we're going to be making, let's say it was $300 to $400 a month per property. Now it's going to be closer to $200 or $300 a month, right? As you're seeing it. So on a per property basis. So that's one way that it's going to affect us. But what you normally see in times like this is people say, okay, well, I'm going to take my pedal off of the gas, and I'm just going to kind of sit around. Which, if you've got a substantial portfolio and you can afford to do that, great, that's fine. You just let equity accrue. And that's one of the luxuries that you have if you have a larger portfolio. But if you're investing for cash flow and you're at the front end of your investing career, you want to actually accelerate your efforts right now. Because what it's going to do is all of those people taking their feet off the gas because money's too expensive, that just means that you decrease the amount of demand. There's going to be less demand for these types of properties. So that should give you a little bit more access to these properties. Now, you still got to be able to move quickly. You still got to have your team put together. But it increases the value or the importance of coming in 70% or below, right? So you can get your money back out. Then once you get everything set up on a fixed rate mortgage, down the road, you can refinance. You can refinance in 3 or 5 years when rates come back to 3 or 4% world. Right back when the Fed decreases the rate a little bit more down the road. That's totally fine. You can totally do that. But in the interim, you have just created a lot of equity. Right? 3 or 4 or 5 years down the road, you're not only going to have someone paying down into your property, your equity, you're also going to have 3, 4, 5 years of inflation, appreciation, market growth, GDP growth, all of those things. That's a good thing. The other, I guess it can be seen as a silver lining, but the other benefit to this is, generally the types of properties that we're purchasing with the BRRRR model, we're seeing per door about a negative $6,000 ledger as the IRS sees the value of that property, right? So it's a tax shelter because from the IRS's view, we're losing $6,000 a year. Right now, because we're paying a little bit more interest and getting a little bit less cash flow, that number is actually going to go up. So now instead of $6,000, maybe it's $8,000 a year per property. And what that means is you can apply those losses to your W-2 income or to your other normal income to offset the taxes there. Right. So in the medium time, you've got more tax shelter, right? Because you're making less money off the property, right? You're making less money or cash flow off of the property. But down the road, you'll be able to have higher cash flow because those property values will have increased and the rental values have increased and all of those things. And then once rates come down, you can still refinance. So it doesn't mean that investing can't be done. In fact, I would argue that now is the time to really overinvest and put in an extra critical eye on deals and put extra time in, because there are a lot of people that are going to say, money's just going to get too expensive. I'm not going to be able to do it. Right. And then this also brings in the value of the program that you've got access to private lenders that are lending exclusively to my students. Right. Those lenders are still going to fund the front end of your deals. And then when you refinance out of that, hopefully you've got all of your money back out once you've done a cash out refinance, and your cash flow is around the 250 range. Right. So that's a little bit of insight from what I expect to happen and what I see happening as a result of the Fed's moves. And so hopefully that's helpful to you guys, gives you a little bit of context for how you're investing and how it's implicated by the Fed's moves. So hopefully that's helpful, and it serves you guys a little bit longer term as you're continuing to invest your time in growing your portfolio. All righty. That is my little my spiel on the Fed's movement. Hopefully that was helpful for you guys. I'm going to hop straight into Q&A, and we can get rolling. Douglas, I see you raise your hand. I'm coming over to you.